The potential financial crisis in the next 3 months. Those of us who understand what is coming and hold the right assets, this will be the only opportunity to increase our wealth. Have you ever wondered what would happen if the entire global financial system suddenly collapsed? Not just a market correction or recession, but a complete meltdown that makes 2008 look like a minor hiccup? Ladies and gentlemen, this isn't some distant possibility. It's potentially just 60 days away from becoming our reality. The warning signs are already flashing red. The US dollar's recent decline is just the first tremor before the earthquake. The real devastation will be triggered within the next 2 months. This is the final window the US government has given us before everything changes. If the Federal Reserve and the global financial powers don't reach a compromise soon, we're facing a financial crisis far worse than 2008. Just look at what happened to stocks and bonds this month alone. Countless people suffering significant losses. And yet, what's coming could be exponentially worse. In less than 2 months, we might witness not just stocks or bonds collapsing, but the entire global asset base crumbling. But here's the silver lining. Those of us who understand what's coming and hold the right assets will have a once-in-a-lifetime opportunity to realize profits and buy assets at rock-bottom prices. I once spoke with a former Wall Street executive who told me something that kept me up at night. Most people can forget their girlfriend's birthday or wedding anniversary. At worst, that costs them a Hermes bag. But if they forget what's coming this June, they'll lose everything they've worked for their entire lives. That critical date is the last day of June this year. In today's video, I'll reveal why June 30th could change your financial future forever, what the U.S. government's $6.5 trillion debt means for your savings, and the 4-phase strategy that the financial elite are already implementing. Most importantly, I'll share how everyday investors like you can not only survive, but potentially create generational wealth during this upcoming crisis. If you're tired of watching your hard-earned money disappear while the wealthy seem to get richer with each crisis, type 1 in the comments below. Let's begin with the most immediate threat. A ticking time bomb that almost nobody is talking about. Number 1. The $6.5 trillion debt bomb and why it matters to you. Why is the last day of June so critical? Because that's when $6.5 trillion of U.S. government debt comes due. This isn't just another financial headline you can ignore. It's a trigger that could set off a chain reaction affecting every dollar you own. Most of this massive debt was borrowed during the pandemic when the economy was in freefall, and the U.S. stock market repeatedly triggered circuit breakers, halting trading. During that desperate time, the Federal Reserve aggressively expanded its balance sheet and flooded the market with money, lending these newly printed dollars to the U.S. government and Wall Street at near-zero interest rates. Here's the real problem. The U.S. Treasury currently has only a few $100 billion left, nowhere near enough to repay the $6.5 trillion debt. And unlike during the pandemic, today's interest rates are no longer near zero. They're at 4.5%. This creates a financial predicament that affects us all. Let me break this down in simpler terms. Imagine I loaned you $1 million 5 years ago with an agreement that you'd pay me back just the principal, $1 million, with no interest by June this year. You'd be happy, right? For 5 years, you've enjoyed spending that money without worrying about interest payments. But now June is approaching. You spent all that money, and you can't repay me. What's your only option? Borrow from someone else to pay me back. But here's the catch. Today's lenders won't give you interest-free terms. Instead, they demand 4.5% annual interest, meaning over 5 years, you'll pay back the $1 million plus an additional $200,000 plus in interest. That's exactly the situation the U.S. government faces. They must convert their near-zero interest pandemic debt into new high-interest debt, drastically increasing their interest payment burden. For perspective, just a 1% interest rate difference on trillions of dollars represents tens of billions in additional annual payments. The immediate consequences? The Treasury will burn through its remaining cash reserves by June. Businesses that cannot afford these higher borrowing costs will fail. Unemployment will rise. Consumer spending will decline. The economy will contract sharply. Warren Buffett and other financial elites have already positioned themselves for this scenario. They've liquidated American stocks and now hold short-term U.S. Treasury bills, the safest assets during the initial phase of this crisis. When markets collapse, they'll be ready to swoop in and purchase quality assets at fire sale prices using government-guaranteed Treasury proceeds. If you want to protect your wealth and possibly benefit from this coming reset, you must understand what comes next. The Federal Reserve's impossible choice and how it affects your money. Number 2. The Federal Reserve's impossible choice. The Federal Reserve now faces a critical dilemma that will determine whether we experience a controlled economic decline or a total system collapse. They have two options, neither of which prevent significant financial pain for average Americans. Option 1. The Fed can expand its balance sheet again, essentially printing money to buy U.S. government bonds, allowing the government to refinance its debt. However, they could maintain the current high interest rates around 4.5%. This would force the U.S. government, and by extension, American taxpayers, to become perpetual interest-paying servants to the financial elite behind the Federal Reserve and other major bondholders. Think about what 4.5% interest means in real terms. When the U.S. government previously borrowed at near zero rates, the interest burden was minimal. At 4.5%, they must allocate hundreds of billions from tax revenues just to service the debt rather than fund essential services or infrastructure. It's like having your salary increase absorbed entirely by a higher mortgage payment. High interest rates are already causing companies across America to struggle. If even the U.S. government pays 4.5% to borrow, imagine what rates businesses face. These unsustainable borrowing costs are triggering bankruptcies, which lead to layoffs. Unemployed workers reduce spending, further contracting the economy. It's a vicious downward spiral. Option 2 is what former President Trump has repeatedly advocated: immediate interest rate cuts. But the Federal Reserve has clearly stated they're not ready to reduce rates, creating an impasse with potentially catastrophic consequences. This deadlock could lead to the demolition option, allowing U.S. bonds to collapse, stocks to plummet, and the dollar to crash in value. Why would anyone choose such a destructive path? Because it forces the Fed to not just print money, but to do so at an unprecedented scale and speed, while dramatically cutting interest rates. When markets are in free fall, half measures won't suffice. Only overwhelming intervention can prevent total collapse. This scenario explains why gold prices are surging while the dollar weakens. It's not a coincidence. It's the first phase of a coordinated wealth transfer. The United States, holding over 8,000 tons of gold, more than the next 3 countries combined, actually benefits from rising gold prices, offsetting potential losses from a weakening dollar. By understanding the strategic financial chess game, you can position yourself to avoid becoming a victim and instead potentially profit from the coming transformation. But first, you need to recognize the 4 phases of this global reset and where we currently stand. Number 3, the 4 phases of global financial reset. We are currently witnessing the methodical execution of a global financial reset, and recognizing its 4 distinct phases is crucial for protecting and growing your wealth during this turbulent period. Phase 1 has already begun: the deliberate devaluation of the U.S. dollar. Since the beginning of the year, the dollar has lost about 10% of its value against major currencies. This isn't random market fluctuation. It's strategic. When the dollar loses value, America's debt effectively shrinks. That $6.5 trillion due in June becomes less burdensome with each percentage drop in the dollar's purchasing power. To accelerate this dollar devaluation, we've seen sharp drops in the U.S. stock market, which triggered global capital flows out of American assets and into other countries. If the U.S. wants to further reduce its effective debt burden before June, we should expect additional significant market corrections between now and then. Phase 2 involves driving gold prices higher, causing both the dollar and global currencies to lose value relative to gold. While this might seem counterintuitive, remember that the U.S. holds the world's largest gold reserves, over 8,000 tons officially, plus approximately 7,000 tons in foreign deposits stored in American vaults. When gold prices surge, America's national balance sheet actually strengthens despite the weakening dollar. Phase 3 will likely begin in July when postponed tariff increases take effect, potentially triggering a global asset and currency collapse. At this critical juncture, the Federal Reserve will be forced to intervene with massive money printing and interest rate cuts, similar to their 2008 and 2020 crisis responses. This will allow American financial institutions to borrow at near zero rates and purchase distressed U.S. assets. The fascinating historical pattern is that while dollar devaluation precedes these crises, the dollar paradoxically strengthens afterward despite money printing. This occurs because when U.S. markets recover faster than global markets due to Fed intervention, international capital floods back into American assets, driving up demand for dollars. Phase 4 represents the ultimate wealth transfer. With strengthened dollars in hand, American financial elites can then purchase distressed global assets at bargain prices. They first sell high, convert to stable assets like treasury bills before the crisis, then buy low after markets collapse, and finally diversify globally when the dollar is strong and foreign assets are cheap. This doesn't have to be just their playbook. It can be yours too. By understanding market timing and asset rotation, ordinary investors can participate in this wealth-building strategy rather than becoming its victims. Now, let's examine the historical evidence that supports this four-phase model and how you can prepare for what's coming. Number 4, historical patterns and your action plan. Financial history doesn't just rhyme. It often repeats with remarkable precision. Before both the 2008 financial crisis and the 2020 pandemic crash, we observed the same pattern. The dollar weakened significantly before the crisis, only to strengthen afterward despite massive Fed money printing and zero interest rate policies. This counterintuitive sequence occurs because before each crisis, American financial institutions sell domestic assets and move capital abroad, inflating foreign asset bubbles while weakening the dollar. When those bubbles eventually burst and American markets hit attractive valuations, capital rapidly flows back to the U.S., strengthening the dollar even as the Fed prints trillions. The most successful investors recognize these patterns and position themselves accordingly. While most people panic during market collapses, the truly wealthy see them as wealth transfer opportunities that might only occur once or twice in a generation. Why do most investors consistently lose money during market downturns? 3 fatal mistakes. Either they don't hold stocks and blindly try to catch a falling knife, buying too early in a decline. They panic sell at the bottom, or they stubbornly hold declining assets hoping to break even while missing opportunities elsewhere. The alternative approach requires discipline and timing. First, identify the market's top signals before the collapse to secure profits. Then recognize the bottoming patterns and trend reversals to re-enter at optimal prices. Finally, determine when to diversify globally after U.S. assets have appreciated and foreign assets represent better value. Here's your action plan for the coming months. First, if you've already accumulated gold, Japanese yen, and other risk-hedging assets since last year, as I've suggested, you're on the right track. These assets are appreciating while the dollar continues declining, validating our strategy for the first half of this financial cycle. Next, carefully monitor what happens in June and July, how the U.S. government handles its debt obligations, and whether they trigger another global asset collapse. If this occurs, consider converting your appreciated gold and yen holdings back to the weakening dollar. Then, when the Federal Reserve inevitably expands its balance sheet, injects liquidity, and drops interest rates to near zero, be prepared to strategically purchase quality U.S. assets at discounted prices. Finally, after U.S. assets have recovered and appreciated significantly, evaluate whether to diversify into undervalued foreign assets using your strengthened dollars. Remember, even if the full crisis scenario doesn't materialize, you haven't lost anything by being prepared. You can simply adjust your investment allocations based on evolving conditions. What makes the upcoming months so critical is that, unlike typical market fluctuations, we're potentially facing a coordinated global financial restructuring that happens only once every few decades. The last comparable opportunities arose during the 2008 financial crisis and the 2020 pandemic crash. Those who understood what was happening and positioned themselves correctly didn't just preserve their wealth, they multiplied it. By understanding the chess moves being played on the global financial board, you can avoid becoming a pawn and instead make strategic moves that protect and potentially grow your assets during this volatile period. Remember, June 30th marks a critical financial deadline that few people are discussing, but which could dramatically impact your financial future. The decisions you make in the next 90 days may determine your financial position for the next decade. If you found value in today's analysis, Please like this video to save it to your playlist for easy reference as these events unfold. Share it with others who might benefit from this perspective. Follow my channel and turn on notifications so you don't miss my upcoming detailed guides on specific investment strategies for each phase of this financial reset. I sincerely wish financial freedom for everyone who took the time to watch this video. If you found even one or two useful insights that help you live better, I've accomplished my goal. Thank you for your attention, and I'll see you in the next video.